Hello and good evening. This is the second part of chapter number 1 of your APM syllabus. We had left at this slide where we were discussing the role of strategic management accountant in strategic planning and control. Now let's just continue with this. Now, what was the topic all about? How a strategic management accountant plays a role in strategic planning and control. That's what we are going to see here. So now let's just see. Number one, what is the major role of strategic management accountant? Providing information. Providing information to the top level management so that they can accordingly make strategic plans. They can keep targets. They can ensure that the shareholders' main objectives are achieved. This is the main part, main duty or role which a strategic management accountant has to fulfill. Another thing. Now, what is happening in the current situation is management accountants. Now, their role is shifting from operational matters to more business support or to strategic matters. In terms of earlier, they used to just be participative in budgeting and control, looking at the day-to-day operations of the business. But now, what they are doing is they are participating in the strategy building, KPIs, CSFs of the business. So they are playing a role of the business support system. This is what they are doing currently. Then he is a provider of information which can be both external and internal, which can be financial and non-financial. So earlier what used to happen was the management accountant was basically involved in giving financial numbers. But now he has to provide information which is external as well as internal, which is financial as well as non-financial. Not only production is to be given by him, he has to give a lot of other information also about employee morale, about the efficiency with which labor is working, about how efficiently the material is being utilized in the production. There are a number of things. Then the next part, now the IT developments. For example, ERPS, which is Enterprise Resource Planning Systems. Now these systems, they are assisting the user to directly input the data in the system, which earlier was being done by the strategic management accountant. He used to gather the information and then he used to produce reports, which were utilized by the top management to make strategies. But now the IT developments, the ERPA systems, and practically SAP is used to do this. So when automatically the entries are made in the system, reports are also generated automatically. So this task of the management accountant is reduced now. At least he is not an information or number provider. Now this number providing task is being carried out by the systems itself. Then the modern management accountant now assists in establishing KPIs, which I just said that CSFs and KPIs also are made or are decided while a discussion happens with this management accountant as well. That means he plays a role here also. So this is the changing role, the strategic management accountant, which he has started doing in strategic planning and control process, which is absolutely a 360-degree change now. Then role of management accountant in providing information to stakeholders. Now this is another thing. What is the role of a management accountant? What role does it play? He plays when some information has to be provided to stakeholders. Now the first thing which comes up is the triple bottom line. Before we go ahead with triple bottom line, let me just give you a small crux of who the stakeholders are. Stakeholders for a business are not only shareholders. Do not confuse stakeholders with shareholders. Shareholders are stakeholders, but all stakeholders are not shareholders. Now let me just expand this. Stakeholders is any individual or any group of individuals who are interested in the organization. What the organization does, how it does, if the organization is going to sustain for a long period of time. Whoever is interested is a stakeholder. They can be the suppliers, they can be the customers, they can be the employees of the business, they can be the government, because government has to collect taxes from the business. Everyone is a stakeholder. Now, how the management accountant plays a role in providing information to these stakeholders? We have to study the triple bottom line concept here. Now, what is this concept? Now, triple bottom line, it focuses onto the economic, environmental, and social areas of a business. Now, for a longer run period, when a business has to succeed, should it just concentrate on the financial numbers? No. It has to concentrate on the society. It has to concentrate on the environment. It has to concentrate on the economic changes which can impact this business, or how this business is economically impacting the nation or the economy of the nation. That is triple bottom line. Now let's just see them in detail. Economic performance. So here comes the economic performance. Now the management accountant has to monitor the financial performance of the organization to ensure that it is fulfilling the shareholders' needs. That's economic performance. It has to fulfill the needs of the shareholders. The basic need, profitability, wealth creation, they have to fulfill. Then environmental performance, better environmental practices. So nowadays what you will see is businesses doing CSR, corporate social responsibility. You will see some of the businesses are maintaining gardens, they are maintaining the government schools, they launch certain programs to clean rivers, to protect the forests, they go for plantation drives. These are all related to environmental performance, how a business performs when it comes to the environment in which it is operating. That means the environmental performance of a business has to ensure that it is sustaining for a very long period of time. It is going to sustain that development and growth for a long period of time. It is not polluting the air, it is not polluting the rivers, it is not discarding waste which can be hazardous for the people living around. These are environmental performance areas. And the management accountant has to see what all costs and what all benefits are going to be there when these environmental friendly actions are done by the organization, by the firm. Then next, social performance. Now, social performance will include what are you doing for the society? Environment is different, social performance is different. What are you doing for the society, for the community as a whole? How you pay off back to the society. Now, what is included under what are you paying back to the society? Again, some costs will be incurred to give something to the society in return. For example, you have your labor. Are you providing good working conditions to the labor? Are you providing them with good amount of leaves? In that case, if they are taking any emergency leave, are you just becoming very rude with them? They should be having some rights, some human rights, some labor laws. Are you following them? That means you are performing good on the societal front, the social front. That's related to the people who are working for you. That's how social performance is measured by a management accountant. He has to keep a track of what all costs and what all benefits you are getting with performing well in case of society, social factors, right? So this is quite a generic one. Now let's come to a very important portion, that's integrated reporting. Integrated reporting. Now what is this integrated reporting? It's a new concept. Now what used to happen was a company or any business, it had to give the details of how environmental and social issues are being dealt with by the firm. In its annual report, it had to give these in different sections. That one section should be related to financial numbers, which give the performance of the business. Another section gives how it is dealing with the environment. If it is really causing any damage to the environment, what steps are being taken by the company to correct those actions. Likewise, for the society, That means for everything, for environment and social issues, there used to be a separate section in the annual report. But now with integrated reporting, only one report must be there without any separate section, which should give how the environmental and social issues are addressed by the company, how they are being taken care of, how the company is managing them as a whole. That's integrated reporting. That means integrating everything in one single report. Now let's go into more deep related to integrated reporting. So there is an organization which is IIRC. What is this IIRC? IIRC is International Integrated Reporting Council. This council was formed in August 2010 so that some framework can be created based on which this integrated report can be made by the entities. Because there should be some framework, some common basis following which all the entities must prepare their integrated report. I mean, if it is free for everyone, they will start making reports as per their own comfort. So this IIRC council was formed in 2010 to give that framework. The IIRC has to ensure that integrated reporting framework is adopted by all the entities. Its principles, its content elements are all present in the report which is produced by an organization. That's the main crux or main idea behind creation of IIRC. The authority which has to ensure that the framework is followed and taken care of by all the organizations, all the entities. Now let's just see something related to integrated reporting and capital. Integrated reporting talks about capitals, different types of capitals. What are these capitals? So IR framework, it prescribes 6 different types of capitals which should work in an integrated manner so that the business performs very well for a very long period of time and it achieves sustainable growth. Now, these 6 type of capitals which are prescribed or recognized by the IR framework, what are these capitals? So they have given all these 6. I have clubbed them here. Let's just see them one by one. Financial capital, capital which is in numbers, finances, your share capital, preference share capital, loan notes, your debt. These are all financial capital. Then manufactured capital. Manufactured capital is simply which is contributing to the production process. In simple words, manufactured capital, which is contributing to manufacture. It can be direct manufacture, like raw material. It can be indirectly assisting the manufacture, means non-current assets, plant and machinery. It is contributing in the production process. Next comes intellectual capital. Now, intellectuals, real value of a company is into something else. What is this something else? Its employees' knowledge, its customer base, its smaller points, that what its customers want. If that company knows that, that's the intellectual capital. That's the value this company has. And this is something which gives a competitive advantage to the company. Production will be done by other competitors also. But what is special with a particular company? That's intellectual capital. Then next, human capital. It relates to people, people's knowledge, people's skill, people health. Who is the crowd in a particular company? That's human capital. Then social and relationship capital. Now every organization has some relationship with other institutions. It can be with customers, it can be with the communities, it can be with colleges, it can be with trade unions. If we talk about MBA, MBA colleges have some relations with the companies also which come up in the campus drives of those colleges to hire the students who become MBAs from that college. The same happens for engineers also. Campus placements. That's social and relationship capital. These companies will be having some good relations with these colleges from where they will be picking up their future employees. That's relationship capital. How they are maintaining relationship with the society, the NGOs, the customers, everyone. That's social relationship, social capital. Then last one, natural capital. which relates to nature, which relates to how efficiently you are producing goods and services with the use of nature. So it has got two parts. One, how you are using the resources of the nature. Number two, how you are discarding your waste also. So these are two parts here. So the use can be renewable and non-renewable resources can be used by businesses. They can be land, water, etc. And when it comes to disposing or absorbing, how you are making the nature absorb your production. Rather, production is not getting absorbed by the nature. The waste which the business is producing, that is being absorbed by the nature. How that is being done? Is it being recycled? Are you giving CO2 emissions to the environment? Are you polluting the river? That is all related to natural capital. Here you are destroying the natural capital. When you are using non-renewable resources, again you are destroying the natural capital. But if you substitute electricity with solar panels, you use solar energy for production, that's making good use of the natural resources, your natural capital. Right? So wherever the question comes up, you may have to use these terminologies when integrated reporting is there in the question. Whenever integrated reporting framework will be there, definitely you will find something related to the 6 capitals. Maybe all 6 are not there in the same case. You may land up finding 3 to 4 in one single case. So that's why you need to be prepared with the content, and then how will we apply them in the questions, that we'll cover up separately, right? Now let's talk about integrated reporting in a different perspective. Now we are talking about that the reporting has to be integrated. You have to produce everything in one single report. What is the management accountant's role here? What is he expected to provide? Again, he is a provider of information. What information he has to give? He has to give information which is qualitative and quantitative both. He has to give the numbers, as well as he has to talk about efficient utilization of resources, what quality of output is being produced, what quality of input are they processing. So it's not restricted to giving an information which is in numbers, but which is qualitative also. Both things are to be covered here. Then he has to capture financial, non-financial measures. Then he has to give information which is forward looking. So the past information only will not work now in the present world. The management accountant will have to provide information which uses the past information, but which gives a path for the future also. That means it should be future oriented. The information should be future oriented. It should give the future of the company, because he has to understand what changes are going to be there in the business environment, and based on that he has to prescribe, this was the past, now we can see this is going to be the future, what action should be taken. A sort of recommendation always is sought from a management accountant nowadays, right? Then he can assist in analyzing opportunities and risks and how resources can be best allocated. So as I said, recommendation of what should be done. So when he will recommend, obviously he will have to first see what are the challenges which the business is facing, what opportunities the business can actually utilize, and what opportunities can really materialize, what all is needed for that. So he have to give that recommendation also. So this is the new role, although you are not supposed to learn them, but you should have an idea that the role of a management accountant now has shifted from an information provider to a decision support manager. Now he is a support system in the business strategy making, right? Now let's come to GRI. GRI is Global Reporting Initiative. What is this Global Reporting Initiative? So let's just see this. This is also a framework for reporting, but what should be reported here? Sustainability. The basic reporting in integrated reporting was related to environment and social issues. But with GRI, this framework talks about reporting sustainability. Sustainability guidelines were also there, So GRI sustainability reporting guidelines, the latest ones have been issued in May 2013. Their name is G4. They are known with the name of G4. Now these guidelines, what do these guidelines provide? These guidelines say that there are three categories under which reporting must be done. What are these three categories? Economic, environmental, and social. So you will say integrated reporting also deals with this. But this in addition talks about sustainability. Business should grow based on sustainable principles. You are growing not on a condition that you finish everything for the future generations. That's the major pillar of GRI. So here the G4 guidelines, they have given two different headings of reporting. One, reporting principles they have prescribed. Two, disclosure items they have prescribed. What are reporting principles? So principles tell what should be the content of the report, what should be the scope of the report, what should the report provide. Everything is there in the reporting principles. That means it acts as a guidance for companies to define that how this report is to be created. That's reporting principles. But when it comes to disclosure items, what is this? Certain issues which for sure must be disclosed. They are disclosure items. That means clearly some management issues, important matters must be disclosed. Then performance indicators must be disclosed. These are under disclosure items. So the GRI, it has got G4 as sustainability reporting guidelines which were issued in May 2013, and G4 says that three categories are there where disclosure is encouraged. These three categories are economic, environmental, and social. Then the G4 guideline says there are two heads under which the reporting must be done. What are these two heads? One is reporting principles, then there are disclosure items. Reporting principles, they clarify what should be there in the report. The principles using which a report should be prepared. Then disclosure items, some critical issues, some critical matters which must be disclosed. They can be important management issues. They can be any major conflict. So there is a list of disclosure items which should be there in the sustainability report, the integrated sustainability report, right? Now just let's see these two parts in more detail. Reporting principles and disclosures under GRI. So reporting principles are, there are principles for defining the report content. There are principles for defining report quality. That means when we talk about reporting principles, they talk about two things: the content of the report, number two, the quality of the report. What should be the quality of the report? Then what should be the content of the report? So when we say what should be the content of the report, it should have a stakeholder inclusiveness. Stakeholder inclusiveness means it should clearly give who all are the stakeholders, how the actions of the entity are going to impact them. That is how we say that it should have shareholder or stakeholder inclusiveness. The stakeholders must be included. The impact of the activities of the business must be included in this report, right? The next, sustainability context. Is the growth achieved by the organization or the business sustainable? In that context, disclosure must be there in the business, in the report. Then materiality, whatever is important, do show that. Completeness, it should be complete in all respects. Now, when we talk about quality, when do we say that a report is having a good quality? There are 5-6 features which should be met to call a report to be a quality content report. What are these qualities? Number one, it should be balanced. That means the report should talk about financial, non-financial, internal, external, bad, good, everything. It should give a balanced view of the business. All goodies and all bads don't work in the practical life. Then comparability, it should provide the user the comfort of comparing the performance of the business in this year to the previous years. Comparability must be there comparing the business with the competitors. Both should be there. Then accuracy, it should be accurate, free from biasness, free from any mistakes. Then timeliness, it should be produced, it should be finalized in a timely manner. A delayed report is of no use for the users of the report. Then clarity, it should be absolutely clear. The report should not revolve around the matter in a chaotic manner. गोल 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 घुमा के बातें करने की जरूरत नहीं होती है रिपोर्ट में. It should be very clear, straightforward. And then it should be reliable. That means the quality can be considered to be good if the report can ensure reliability on its numbers, the facts produced by it. So reliability is really important. Now, when we say disclosure items, so disclosure items under this report, they are categorized into two different parts. One, general standard disclosures, then specific standard disclosures. General disclosures are generally disclosing the strategy of the business, then what is the organizational profile of the business, then material aspects and boundaries, that these are the departments, this department has to handle this work, they have to produce only this, nothing beyond that. These are the boundaries which are to be clearly spelled it in the report. Then stakeholder engagement, how stakeholders are engaged, how they are kept happy, informed. Then report profile, governance, ethics and integrity. These are the general disclosures. How ethically, how the governance is going on, what type of ethics are being followed by the organization. These all must be there as general disclosures. But when it is specific disclosures, specifically, how is the management of the business dealing with issues? They are specific disclosures, and that we can say that they are the management approach, style of managing. That has also to be given in the report. They are specific standard disclosures because they differ from company to company. And specifically, they will talk about management's different approach in different circumstances also. They are special. That is why they need specific disclosure, right? Next, let's come to benchmarking performance now. Benchmarking. Bench पे mark लगाना. Quite pathetic joke. Benchmarking. It simply means keeping someone as a benchmark or keeping someone as an ideal. We have to reach at a sales number of 1 lakh units. That's a benchmark for us. In 1 year, we have to achieve a sales number of 1 lakh units. That's a benchmark. So benchmark is typically saying that we need to reach this target. That's benchmark. Now benchmarking performance, benchmarking or benchmarks can be segregated into 3 different types. They can be internal benchmarks, there can be competitor benchmarks, and then they can be process benchmarks. Now let's see what is internal benchmarking. When you use another function or division of the same organization as a benchmark, that is termed as internal benchmarking. That means I am making my own division as a benchmark. Now just imagine you are in the class and your teacher comes up and says, you have got the highest marks. Now ऐसे बनो. Just see how beautifully he has written the answers. आपको ऐसे लिखना है एग्जाम में. Now this is a benchmark. और ये internal benchmark होगा. How? Internally, when the departments of the organization, they are made a benchmark for others to follow. That's an internal benchmark. Now next, competitor benchmark. When you try to reach your direct competitor, you keep his performance as a benchmark. With the same industry, the same business, same processes, he is your competitor. When you keep him as a benchmark, then it's a competitor benchmark. Then the third one, process benchmark. What's that? When you keep any process as a benchmark of a particular non-competitor company. Now this company is not your competitor, because the moment it becomes your competitor, it enters into the competitor benchmark. It is no longer a process benchmark. So for a benchmarking to become activity or process benchmark, it has to belong to a non-competitor. He should not be your competitor. The moment he is a competitor, then it is competitor benchmark. So be very careful with this. These are three different types of benchmarking. Now, let's just see benchmarking, another classification which is seen in companies. Benchmarking can be strategic benchmarking, it can be functional benchmarking, and the third one can be operational benchmarking. What is strategic benchmarking? So it keeps the GP margin as a benchmark. Major strategy will revolve around getting something which is very big, which impacts the whole organization. The production department, sales department, as well as the supplier, everything is impacted. That's specific strategic benchmark. Market share, it's a very big benchmark which impacts the whole company. Company hill jayegi with this benchmarking. Then functional benchmarking, which relates to a particular function. That means percentage deliveries on time. That is related to one particular function, not to the whole organization. It can relate it to lowest wastage or this much percent of wastage maximum in use of raw material, related to only production. The sales team, marketing team, finance function, they have nothing to do with this benchmark. That's functional benchmark. Then the operational benchmark. Now, operational benchmark is absolutely linked with operations, day-to-day manufacturing. They are related to, there can be a performance gap in the functional benchmarks, or there can be a performance gap in functions, different functions. To fill that gap, operational benchmarks, they are kept. So for example, I take an example here. There is a functional benchmark which a particular production function is keeping. They are saying that we will just ensure that the production happens with only 1% of wastage. That's a benchmark this function has kept. Now what happens? The wastage happens to be 3%. Now operational benchmarks will come into picture that something has to be done to improve the efficiency of the labor or the machinery or the material, so that this 3% of gap that comes down to 1%. That is what can be done here as an operational benchmark. So operational benchmark will always work towards filling the performance gap in functions, in functional benchmarks. So they will be talking about more onto correcting the numbers or the performance gaps. That's these different styles of benchmarking also exists. Now this is a long benchmarking process which is there in your book. I just had to take this, but let's just quickly do it. It's nothing important which you need to mug up. Let's just see this. So number one, step one, set objectives and determine which areas to benchmark. That means you first need to set the objectives, that this is what we are trying to achieve. 2. Identify the key performance indicators, the KPIs, which should be measured during benchmarking. Step 3. Select the partners for benchmarking comparison. That means which type of benchmarking you would like to do. Step 4. Measure the performance of all organizations involved in the benchmarking process. Step 5. Measure your own performance and compare it to the benchmark. That means when you have already measured the performance of your competitors or your partners, now it's your turn that you measure your own performance. Step 6. Now, if there is any gap, specify certain actions so that this gap can be reduced. Step 7. Now monitor the actions, corrective actions. If there is still any gap, try to cover it up. This is a process, although I'll strictly say not to be learned. There is nothing important on that. Now, this is something important. Performance comparison with the competition. So this is a separate topic given in your book, which holds quite an important place in the practical case studies. Now, benchmarking, it can take two different shapes. One, it can be intra-group. Two, it can be inter-industry. Intra-group is, there is a company which has got a number of subsidiaries. This is a group. Now, when benchmarking is happening between these group members only, that is termed as intra-group. Now, what's inter-industry? Inter-industry means, now there is a particular industry, let's say textile industry. When you try to compare their productivity with the productivity of FMCG industry, although that's quite stupid to compare, non-competing firms, if they try to keep benchmarks related to this, non-competing industries, FMCG versus textile, that's inter-industry. Now you will say, who will do that stupidity? That someone is in the textile industry and he wants to keep a benchmarking for its own business which belongs to an FMCG sector. Okay, I can do one thing here. Why not do that? Travel industry and hotel industry, they are two different industries, but still they work together. Why I took textile and FMCG? They are all the basic needs of a human being. But yes, again, there is a small difference. FMCG sector, if it is related to food items, that is a necessity. When textile, it is related to luxury clothing, it is not necessity. So some businesses can go ahead with taking textile, which is a necessity on certain parts, normal routine ghar ke kapde types, and FMCG also daily routine ka khana, food items. So they can keep the other non-competing industry as a benchmark. They can keep that. Now, for example, there are three boxes here in front of you. What are these three boxes trying to tell you? They're trying to tell if you have to do a comparison with your competitor, how can that be done? Now, first box tells you the level of investment in fixed assets of competitors. Now, how do you get to know how much investment the competitor has done in the fixed assets? How will you know that? One, you can physically observe that. You can visit their factory, see what is the amount of investment they have done in the plant and machinery. Two, you can gather this information from press releases. You can gather this information from trade association announcements. Then third, they have their published financial statements also. You can get the value of the fixed assets from their balance sheets as well, which is a published document. Then what if we need to find out the operating methods which are just applied by these assets, how these assets are operated, how they are carrying on their operations? If we want to understand that, what can be done? One, observe the hours and shift patterns, how the operations are being done. They are working 24/7. They have staff who is working for 8 hours, 8 hours, 8 hours like this, or they are just working for 8 hours in a day. That's how they are operating these assets. Then you can discuss this with the suppliers and customers, how they produce this. Suppliers can also tell that. Gathering information from existing as well as ex-employees. This way you can understand how your competitor is operating the assets, how his operations, business operations are going on. Then the third part. Now what if you want to know about the pay and working conditions which your competitors are following? So pay to the labor, pay to the employees. How can you know about that? So there are some nationally negotiated agreements. You can refer to these. Some reference can be taken to these. If you refer them, then probably it's a good deal that you land up into knowing that what is the rate which is agreed nationally and this company follows the rates. For example, you can say there is a sixth pay commission in India. The central government employees have to be paid based on the sixth pay commission, seventh pay commission. So with the seventh pay commission coming into picture, if any organization says we are paying our employees based on the seventh pay commission, that means you come to know that what is the pay grade of the employees given by your competitor. Number two, National press advertising, local or national press advertising, trade unions, employment associations, they can also be a source where you can get this information, what type of pay packages your competitor is giving to the labor or the employees. Then recruitment consultants can also be a good source of gathering this information. Placement agencies, right? Now, there is an important point to note here. That's good that you perform an industry comparison here. You want to do that. You need to assess how the resource utilization takes place in other countries. Now, what usually happens is you are comparing yourself with other organizations in the same industry, and now you feel, oh, we are performing very bad. Try to compare it with other countries also. Why? Maybe your own country is facing this glitch of poor performance. Maybe your own nation is badly impacted. And when you assess the performance of the similar industry companies in some other country, at least you get to know if you are bad performing because it is an economy case, or only you as a particular business is failing in achieving the targets. So that's a better assessment, that you actually see difference between the performance amongst countries also. How they perform, how are we performing? So when we say the pandemic has hit us badly, is it hitting everyone badly? That's the correct basis of analyzing if we are poor performers or it is globally being a case of trouble. That's how we can assess, right? So this has to be clearly compared. Now let's just see models which are used in the performance management process. There are 4 or 5 models which are used for managing performance. They are SWOT analysis, then Boston Consulting Group, which is BCG matrix, then Porter's generic strategies are there, Porter's 5 forces are there, and balanced scorecard are there. In this chapter, we will take care of only the first 3, not rest. So like we'll see SWOT analysis, then BCG matrix, Porter's generic strategies also, right? So now let's first see SWOT analysis. What is SWOT? Strength, weakness, opportunity, threat. SWOT analysis, why is this analysis done? It gives a summary of the present situation in which a company is working, a company is operating. It tells you what is the strength the company has, what are the weaknesses on which the company has to work, what are the threats which the company may get exposed to, and what are the opportunities, strengths, weaknesses, opportunities, threats, which the company should utilize the opportunities, right? So SWOT analysis gives 2 types of studies here, one which relates to the internal environment, another which relates to the external environment. Internal environment analysis will deal about the internal systems of the company. It will talk about strength and weaknesses of the company. That's an internal environment case. When we talk about threats and opportunities, that's an external environment case for a business. Threats will come from outside, although they can be internal also, but majorly they come from outside. Opportunities also will come from outside. Again, they can creep from inside internal environment also, but still it's more likely that they will be belonging to the external environment. Now let's just see something which relates to internal environment, relate to resource and competencies. That means what is the organization good at? That's the strength of the organization. What is the organization poor at? Weakness. Where are resources in short supply and where are resources excellent? Wherever resources are excellent, that's a strength for the business. Wherever the resources are in short supply, that's a weakness for the business. Now let's come to external environment, opportunities and threats. How will economic change impact the organization? There is an economic change. Are we going to be troubled with that? Can the organization make use of new technologies? Is there any opportunity? Can new entrants enter the marketplace? Threat. Can competitors enter the marketplace? Can a powerful customer dictate terms? Threat. Can there be a case that you are serving a customer who is powerful enough that he starts dictating you the terms of purchase? These are threats, right? So these are generic questions. You need not mug them up. But yes, what you need to remember is SWOT analysis is about analyzing the current situation of a business, its strengths, its weaknesses, the opportunities it can utilize, and the threats which can be devastating for a business. This is SWOT analysis. Now let's talk about BCG matrix, Boston Consulting Group matrix. So BCG matrix talks about the portfolio of product or markets in which a business operates. That means, let's take an example of ITC Limited. ITC Limited has got a portfolio of products. Let me show you that screen so that you understand what ITC Limited, which ITC Limited I'm talking about. Just a second, I'll bring that screen in front of you. And here it comes. So now in front of you, you can see the different brands, different product which ITC offers. Ashirvad Atta, Bingo, Sunfeast, Yippee Noodles, Dark Fantasy. Then there is ITC Hotels, John Players, Savlon. Then there is Shar and Shar, Classmate Registers. Then there is Minto. Then there are Papercraft, Fiamma, D-Wills, a lot of things, right? That means there are companies who have multiple products in their portfolio, who actually are selling big deal, great deal of products. Their markets are different, their products are different. Now this BCG matrix is going to help you understand something related to such businesses who are having different products which are being sold in different markets also. So let's just get back to the PPT again. And here we are, right? So now what does the BCG matrix tell us? It actually shows a matrix. It is in the form of a matrix which is used by firms to decide what products in their portfolio should be kept, what should be discontinued, which market should be continued, which market should be exited, right? So this is a matrix. This looks like this. This matrix look like this. So there are 4 categories here. I have taken this screenshot of this matrix from the study text itself. It takes care of 4 different quadrants here. It talks about a star, it talks about a problem child, then a dog and a cash cow. These are 4 different quadrants which are being defined here by the BCG matrix. Now let's just see the star. Here we'll talk about market growth and relative market share. Market growth, relative market share. Stars. Who are stars? Whose market growth is really high. Their relative market share is also very high. Cash cows. Their growth is low, but their relative market share is very high. Problem child. Market share is low, but market growth rate is quite high. Dogs. Their market growth is also low and their market share is also low. That means dogs are really loss making. Nor they have future growth which can happen, nor they have current market share. Problem child. Growth is expected, but currently they do not have a good market share. Stars. They have good growth prospects as well as currently also they have good market share. Then comes cash cow. Currently, they have good market share, high market share, but when it comes to growth, they have already reached their saturation. So that is how this market growth and relative market share, they are being used to create this matrix. And there are 4 different boxes which are being named as star, then problem child, dog, and cash cows. Now let's just go into more details on this. What are stars? So stars are large share of high growth market. Yes, growth is high. High reinvestment rate required to hold or build position. So stars, if any product of any company falls in the star category, then some high reinvestment must be made because they have a potential to grow. Reinvestment is to be done. And their cash flows is moderate because they still have some scope of growing. when they will be in the growth phase or already reaching the peak, that would be the time when the cash generation would be really high with them, right? Now let's come to problem child. Problem child, small share of high growth market. That means their share is really low, but their potential of growth is high. That means market is growth market, but their share is small. Large investment is required to grow. Here also, large investment is required, or divest. So why is it saying that divest? If in any case growth is not achievable, or you are looking in a way that you do not have managerial skills that it grows, it's better to divest. So either you reinvest, make it successful. If you can't make it successful, then better to divest it, right? Now let's come to dogs. They have small share of low growth market. That means the possibility of growth is very low. The market share is also low. Negative cash flows. They do not bring cash inflows. Either they bring negative cash flows or very less types. They are strictly a good candidate for divestment. Sell them off. So if there is any particular product in the portfolio of a company which they can see that it is falling under the category of a dog, it's better to divest it. Don't invest further amount of money in making it recover. There is no use, and that is why we are using this matrix, so that a company can strategize what should be done next. So first decide which quadrant your product or your division is falling. Wherever it falls, take the decision accordingly. Now last one, the cash cows. The cash cows, they have large share of low growth market. That means their growth expectation is quite low, but their market share is very high. Because they have high market share, that means they must be generating good amount of cash. That is why they are termed as cash generators. Next, strategy is minimal investment to keep the product going. So there is no further reinvestment required, because here the product is already reached its highest peak. So no further reinvestment must be done. But yes, some sort of minimal investment must be there, so that the product at least keeps on going. That can be done for this, right? Now let's just see more details about market growth. What is market growth? It is the percentage increase or decrease in the annual market revenue. When we say market growth, it talks about market revenue. Market revenue is most recent revenue divided by the most earliest revenue, and number of periods of growth. Market share. So market share is your own division's market share divided by the largest competitor's market share. Or you can say, out of the total market, how much is your share? That's relative market share. Then divisional market share is divisional revenue upon market revenue. Relative market share, if it is greater than 1, it means that the division is market leader. Now what is happening here is, very carefully see this point. Divisional market share, it's the total market revenue, that should be in the denominator. Division's revenue should be in the numerator. That gives you divisional market share. So out of 100, if your revenue, the division's revenue is 20, divisional market share comes out to be 20%, 20 upon 100. That's divisional market share. Now what is relative market share? Now you have 20%. What is the largest competitor's market share? Let's suppose he has 80% market share. Now what is your relative market share? 20 upon 80. 1/4 is your relative market share. 20 upon 80. 20% your own market share, divide by 80% your largest competitor's market share. That means your relative market share is 20 upon 80. That's 1/4. Right? Now what is the last sentence trying to say? This sentence. A relative market share which is more than 1. We here assumed that we are at 20, the competitor is at 80. So my relative market share came to 1/4, that is less than 1. Now what if it is more than 1? More than 1 means Let's take the reverse situation. Now my division's market share is 80% and largest competitor's market share is, let's suppose it is 20%. That means my relative market share is more than 1. That means here you are the market leader. You are the market leader, right? So here it is the largest competitor's market share, next then you. Next then you, who is the largest competitor, take his market share. Keep it as a denominator. So when I am at 80%, next largest competitor is at 20%, I get a relative market share of more than 1. That means I am the market leader, right? This is how this is calculated. Although it's not going to be there as a practical question, just because it was there in the study text, I had to include it so that we don't miss out on anything, right? Okay. Now let's talk about something else on BCG matrix. Now, why are we using this BCG matrix is simple: to create an effective strategic plan. Because until and unless we know where the product of the business stands, how will we strategize? If to divest it, if to further reinvest some amount in the product, if to keep it intact, what should be done? For that, you need to first place the product in any of the quadrants. Then only you can decide. Then there is a difficult situation here. Sometimes what happens, you think that a particular product is a star, but it turns out to be a dog. That's a problem. That's a practical situation which has happened a number of times with companies. What happens here? Now, sometimes the companies think that they need to invest more money in the development of a product which they think that they are potential stars. But later on, these products turn out to be dogs. And then finally, they have to divest it. They have to sell them off, stop manufacturing that product. Any practical example? Yes, Tata Nano. So Tata Nano, when the idea was launched, it was a big dream for every buyer, every consumer. Everybody started thinking that yes, we are going to own a car in less than 1 lakh of investment. But then some problems with the land and a number of things happened, and suddenly it had to close down. That means which was expected to be a star that turned out into be a dog. Let me show you the extract so that you can link the whole concept with a practical example here. I'll bring that in front of you. Just a second. And here it is, right? So this is the extract of Tata Nano, which I was referring to, that it was once dreamt to be a star, but then suddenly it turned out to be a dog, and the production of Tata Nano was halted. So this is the Nano, which you can see in 2017, Tata Motors said manufacturing would continue due to the company's emotional commitment to the project. Production was eventually halted in May 2018. Now with this, Tata Motors projected production figures of 250,000 annually at launch. This was not achieved, and various factors led to the decline in sales volume, including delays during the factory relocation from Singur to Sanand, early instances of the Nano catching fire, or the perception of car being unsafe and lacking quality due to cost cutting. So this was the basic thing, because when it was launched, it was a case of heavy booking, and I'll take you to that page where it talks about complete end of this car. Here it is, end of production. Due to the low sales of the model, only one Nano was assembled in June 2018 against the 275 assembled in June 2017. Tata Motors announced the end of production without any direct successor. That means there was no new announcement of any new car. The Nano was never really appreciated by the public, and sales were always lower than expected. On the other side, I remember when Mr. Ratan Tata, he announced a car which can be affordable for everyone could come up and invest less than 1 lakhs and get a car. This idea was appreciated like anything. It was a case of huge bookings for Nano, but then it landed up like this. So this is a typical case which I was referring to, that sometimes this problem can come up when a company can consider that a particular product is a star, but it can come out to be a dog. And then finally, it has to be divested, sold off, or it should be just discontinued in the production process. Now let me just get back the PPT again. And here we are, right? So this Nano case was absolutely this instance of this particular statement, that distinguishing between a star and a dog can be a problem. Now let's just move ahead. Now there are some benefits of the BCG matrix, but there are some drawbacks also. The biggest benefit is it ensures that a business should have a balanced portfolio of products. That means it should have a product where some investment is required. It should have a product which is type of a cash cow which keeps on generating cash. Another benefit, this matrix can be used to manage divisions in different ways. That means focusing on cost control at one place, then further investing money in another product or another division. That can be easily managed when this matrix is used. Then matrix used by the division can be in line with the analysis. That means matrix for high growth prospects may be based on profits and ROI, and matrix for lower growth prospects will focus on margin and cash generation. So they are just saying that the way you are doing the analysis, you can a bit change the matrix. When it is about high growth, when it is about high prospering divisions, then it can be high ROI, it can be high profit. But when it is about low growth prospects, then it can be only related to cash generation or just meeting the margins. Then it looks at the portfolio of divisions as a whole rather than assessing the performance of each one separately. That means it talks about different products being run by a company, and as a whole, what is the impact of those products on the company. It doesn't analyze one single product, how is it performing, bad, good. It doesn't individually do that. It rather presents you a situation of the company as a whole. Then it can be used to assess the performance. That always can be done. If someone is a very good performer, then he can be a problem child, the product can be a problem child, the product can be a star also. But if the performance is good but there is no scope of growth, then you can always come up saying that the assessment of the performance says it is a cash cow, right? Then what are the drawbacks of this matrix? It's too simple, but the practical life is not that simple. There can be indicators where you think that a particular product is a star, but it turns out to be a dog. We just saw that. That is a drawback of this matrix. Number two, it is designed as a tool for product portfolio analysis rather than performance measurement. Now, what is the main idea behind making this matrix is it is more of portfolio management tool rather than evaluating the performance of a particular product or division. Then it downgrades the traditional measures such as profit and so may not be aligned with shareholder objectives. It talks about generating cash. It talks about future growth, but doesn't talk about anything related to profit. But for the shareholders, what they are concerned with is just the profits. Then next, it determines what high and low growth and share mean in different situations. So for them, it's very easy to define what is high growth, what is low growth, what is good share, what is bad market share or low market share. But practically, that is difficult to define. Absolutely right. It does not consider the links between business units. A dog may be required to complete a product range. Absolutely right. So sometimes what happens is companies have to keep a dog. Why? So that it support other products. They have to do that even if the product is not a profit making product. This idea is ignored by the BCG matrix. Now these are the drawbacks. Now there are some other problems also which are in the BCG model. What are these problems? Something more in detail. With the problems which we just saw, more details are discussed here. The first thing, the biggest problem is its simplicity in measuring the market attractiveness and competitive strength. That means how much is the market share and how much is the market growth going to be. Is it that simple to identify? There are, for them, they are just saying that only these market share and then this competitive strength, these are the driving forces. But there are other forces also which make a product successful. They are brand image, they are the quality of the product, after sale service of the product. There is no reference of these things in this matrix. That's another problem with BCG. Then another problem, its assumption that the attractiveness of marketplace is indicated by the growth rate of the market. Sometimes what happens is, it assumes, this BCG matrix assumes that a marketplace is attractive if it has good growth rate. Sometimes what happens, there are certain markets which have got good growth rates, but there your product is not accepted. Maybe your product is accepted in another market which has got a low growth rate. There you take up good market share. This problem is absolutely ignored by BCG matrix. Then next comes, at the time of measuring the market is another problem. At the time of measuring the market, that means we are trying to, this model, it tries to define the marketplace. What is a marketplace? How much big is the market? How do we calculate the growth rate? How do we calculate the relative market share? We need total market for that. Now, how do we calculate the total market? That's another problem with this model, right? So there are these problems which you can generally just read, but majorly in the exam, you will have to apply them as per the case, not as per the rata-rataya style of this matrix. Now let's come to Porter's generic strategies. So they are quite easy. So Porter recommended any organization has to achieve competitive advantage. So it has to see three strategies for it, has to follow three generic strategies for it. What are these three strategies? One, cost leadership. Number two, differentiation. Number three, focus. So simply put, if a company, if a firm wants to get a competitive advantage, it should follow three strategies. One, cost leadership. Two, differentiation. Three, focus. Now, what are these three? What is cost leadership? Cost leadership is you being able to manufacture the same product which your competitor is also doing, but you are making it at a cost which he cannot match. That's cost leadership. Invest in latest technology. Go for large scale economies. Go for good negotiation skill with the supplier and try to bring down your cost as low as possible. It will make it difficult for the competitor to match your cost. This will lead to your profit margin increasing. That's cost leadership. Now, what's differentiation? Differentiation is simply when your product is a bit different from the competitor. It can be in terms of image, it can be in terms of quality, it can be in terms of design, whatever. It should be a bit different from what the competitor is offering. Then last, focus. That means the business should focus on a particular niche in the market. It should not launch a product which is applicable for everything. So we talk about shampoos. Earlier, shampoos and soaps used to be very generic. Lifebuoy was everywhere. Hammam was everywhere. But now you will find Dove, people with dry skin. You will find Medimix, people with acne. You will find Fairness Glow soaps for people who want to be fair. Fair and Lovely. And for the men also, there is this soap, handsome, some, I don't remember what type of cream is that. So they are all focusing on a particular market. Fairness products, beauty products, products which are there for men also to become fair. This is focus, not making a generalized type of a product. Even Atlas, the cycle company, it also focuses on cycles for different ranges of people. The market is very niche in terms of it is not making much of sports cycles. They are more into normal cycles for the common man. That's their niche market, right? With this, we finally end this chapter. It was a pretty long chapter, but yes, we have succeeded in completing it. I hope you could understand this chapter very well. But yes, there is a task for you to do. You need to read this chapter completely from the study text also. Because once we will be done with some group of chapters, we will directly reach to exam kit questions so that we can side by side handle them. But yes, with one single chapter, it will be quite difficult for you to handle the exam kit. So better we do that with some collected number of chapters. So do read the study text well. And if there is any problem, please feel free to reach me for this. Thank you so much. Take care and keep on studying.